In this video, I'm going to walk through a multi-product break-even analysis. To this point, when we've done break-even calculations, we've just been a company that sells a sole product. And while that is realistic for some companies, it's not realistic for many companies. So we're going to pivot a little bit and at least be a company that has two different products. It makes two different computer games, and that's going to be Claim Jumper and Makeover. And our second task here is to calculate the overall break-even point in dollar sales. Good news, we can use a lot of the knowledge we already used to prepare a break-even for a single product. We're going to first need our contribution margin ratio for the company as a whole. We're not breaking it down by Claim Jumper or Makeover as the company as a whole. Recall that contribution margin ratio would be contribution margin dollars. In this example, our total contribution margin dollars for the company overall is $30,000. Divided by our sales in total for the company, irrespective of Claim Jumper or Makeover, which is $100,000. And so our overall contribution margin ratio for the company is 30%. Also in the past, we've covered the formula for break even and dollar sales, and that would be fixed expenses divided by the contribution margin ratio. And again, we're looking at the company as a whole. Our fixed expenses in total, we didn't even try to divide them up between Claim Jumper and Makeover, is $24,000 divided by the contribution margin ratio we just calculated of 30% means our sales overall between Claim Jumper and Makeover need to be $80,000. So that can be helpful. We need to sell $80,000 overall. If you're an individual manager, though, it's not as helpful then to know, well, how much of that $80,000 does Claim Jumper need to sell and how much does Makeover need to sell in order to get a profit of zero? So our last task here is to restate our contribution format income statement that we previously had are at $100,000 sales level and net operating of $6,000. At the break-even point where we know the sales are going to be $80,000. So let's work along with that. The template's going to be the same. Sales minus variable expenses equal contribution margin minus fixed expenses equal net operating income. And you'll note I've already filled in some of the information. For example, I already filled in that total sales is going to be $80,000. Why did I do that? Because we're restating this at the break-even point and we already identified total sales at the break-even point are going to be $80,000. I also listed that fixed expenses are going to be $24,000 in total. Where did I get that? Well, fixed expenses aren't supposed to change within the relevant range if you just change the sales level. So our assumption is that that's true in this scenario, that fixed expenses are still going to be $24,000. Also, I already listed net operating income / loss is going to be zero because we're talking about the break-even point. We're talking about the point at which our sales just cover our total expenses, so therefore our profit or net operating income is going to be zero. Those are the easy parts. The harder parts is how do we divide up the rest of the information between Claim Jumper and Makeover. The first task I want to take is dividing up this $80,000 in sales and trying to figure out how much goes to Claim Jumper. Our assumption is this: a relative product mix is going to stay the same irrespective of whether our sales is $100,000 or $80,000. What do I mean by sales mix? What percentage of the sales is Claim Jumper versus Makeover? So currently, Claim Jumper is at $30,000 of $100,000 in sales. Makeover is $70,000, so it adds up to be $100,000 total. So currently, the sales mix of Claim Jumper is 30%. Makeover, even though I don't have the number listed here, would be 70%. Our assumption is that 30%, 70% sales mix is going to stay the same. So we're going to take our new sales level of $80,000, because that's our break-even point, times 30%, because we assume the sales mix stays the same for Claim Jumper. And so Claim Jumper's sales level at the $80,000 total sales for the company overall would be $24,000. So that's one part of the puzzle fit in. The next part is going to be a little bit more challenging. What is going to be our variable expense? Our assumption is that the variable expense ratio For Claim Jumper versus Makeover, the variable expense ratio is going to stay the same. We're not predicting that the unit costs for variable costs are going to change. We're just predicting the sales volume is changing. So let's go ahead and calculate the variable expense ratio for Claim Jumper. In one of the early videos for this chapter, we talked about that would be the variable expenses, which in this example are $20,000, divided by the sales, which in this example is 30%, would give us a variable expense ratio of 2/3 or 66.66 on and on. And I'll note, take this out as far as possible, because if you round it to 67%, you're going to have a bit of a rounding error. Now, if I take that 66.6 on percentage times our new sales level of 24%, we get an expectation that if Claim Jumper is selling $24,000, their variable expenses are going to be $16,000. So we can go ahead and fill that in with our income statement. If variable expenses are $16,000 and sales are $24,000, our contribution margin for Claim Jumper must be $8,000. In the interest of keeping this video as short as possible, also to make sure you can work through the scenario on your own, I'm going to let you calculate the sales, variable expenses, and contribution margin information for Makeover, and also the total variable expenses and contribution margin overall for the company. But hopefully this got you started on being able to calculate our break-even analysis.